This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Bargain Sale Gifts, Part 2, Capital Gain Property. This is Professor Russell James. If an investor pays $500,000 for an item of property, such as shares of stock, and then later sells that property for $1 million, the investor has a capital gain of $500,000. The $500,000 paid for the property is referred to as basis. The capital gain is simply the amount the investor received for the property less the amount the investor paid for the property, or in this case, $1 million minus $500,000. This passes over, for the moment, other potentially complicating factors that can alter the basis, such as additional investments in improving the property or depreciation deductions previously taken, in order to focus on the basic concept of capital gain as the difference between the money received at sale and the money paid at purchase. In another example, if the investor pays $500,000 for an item of property and then later sells the item of property for $500,000, the investor has no capital gain. There is no profit to be taxed. These examples show the relative simplicity of calculating capital gain in a typical transaction. This simplicity changes dramatically, however, in the context of a bargain sale. Suppose the donor pays $500,000 for property and the property grows in value to $1 million. However, instead of selling the property for $1 million, the donor wishes to benefit a charity, and so he sells the property to the charity for a bargain price of $800,000. What is the donor's capital gain on this type of transaction? The tempting but wrong answer is to simply subtract the $500,000 purchase price from the $800,000 received from the charity. This is not the correct answer. The donor does indeed receive $800,000. However, because part of the value of the property was donated, part of the $500,000 basis in the property will apply to the gift portion of the transaction. Only the remaining share of the basis will be applied to the sale part of the transaction, and only this sale portion of the basis may be subtracted from the $800,000 received from the charity when calculating the capital gain. The next section walks through this calculation process step by step. The first step in calculating the capital gain resulting from a bargain sale transaction is to divide the property value into the gift part and the sale part. In this case, the donor gave property worth $1 million to the charity in exchange for $800,000. Thus, $800,000 of the transaction was a sale, because the donor received full compensation for that share of the property. The remaining $200,000 of the transaction was a gift. Another way of thinking of this is that the donor sold 80% of the property and gifted 20% of the property. The donor received $800,000 from the sale part of the transaction. Thus, the donor will have $800,000 of capital gain income less the sale part of the donor's basis in the gifted property. Determining the sale part of the donor's basis requires dividing the basis between the sale part and the gift part. Because the donor is treated as having sold 80% of the property and gifted 20% of the property, 80% of the basis will apply to the sale part of the transaction, and 20% of the basis will apply to the gift part of the transaction. Thus, the $500,000 original cost basis is divided between the sale part and the gift part of the transaction. Because 20% of the value of the property was gifted to the charity, 20% of the $500,000 original cost basis, in other words, $100,000, is applied to the gift part of the transaction. The remaining 80% of the value of the property was sold, In other words, the donor received full compensation for 80% of the value of the property. Thus, 80% of the $500,000 original cost basis, in other words, $400,000, is applied to the sale part of the transaction. Because the donor received 80% of the value of the property, the donor can use 80% of the value of the cost basis when calculating capital gain. In this case, 80% of the cost basis is $400,000. This is the portion of the cost basis applied to the sale part of the transaction. The donor's capital gain is the $800,000 he received from the bargain sale transaction, less the $400,000 of basis that applies to the sale part of the transaction. Thus, the donor's capital gain is, in this case, $800,000 minus $400,000, or $400,000. It may seem disadvantageous to lose the ability to subtract the full $500,000 basis. Consider, however, the alternate transaction where the donor sold the property at a fair market value of $1 million and then gifted $200,000 of the proceeds to the charity. The charity would receive the same $200,000 benefit in either transaction. However, if the donor sold the property, he would pay tax on $500,000 of capital gain, the $1 million sale price minus the $500,000 basis. By using a bargain sale transaction, the donor has reduced his capital gain from $500,000 to $400,000. Considering that combined federal and state long-term capital gain tax rates, including Affordable Care Act taxes, can be in excess of 33.33%, structuring this transaction as a bargain sale rather than a sale then gift can result in substantial tax savings for the donor. The basic principle of calculating capital gain in a bargain sale transaction is simply that the percentage of the property value that is sold, in other words, the percentage of the fair market value the donor receives in exchange for the property, is the percentage of the cost basis that can be used for calculating capital gain. The most important idea is to avoid the temptation of simply subtracting the amount paid for the property, in other words, the whole basis, from the amount received for the property. Although this works for other types of capital gain calculations, it is not appropriate here because part of the basis is applied to the gift part of the transaction. The last section reviewed how the sale part of the basis is used to calculate the donor's capital gain. But what happens to the gift part of the basis? When would a donor use this in a tax calculation? The basis in gifted property is not relevant when the property can be deducted at its fair market value. In such cases, if an item of property were worth $100,000, the charitable deduction for gifting such property would be $100,000, regardless of the basis in the property. However, some types of property gifts to charity may be deducted only at the lower of basis or fair market value. For example, gifts of unrelated use tangible personal property are deducted at the lower of basis or fair market value. Unrelated use here means that the charity will not be physically using the tangible personal property item in furtherance of its charitable mission, but most likely will instead be selling the item and using the proceeds. In the case of a bargain sale involving such property, the deduction would be limited to the gift portion of the property's basis. Similarly, a gift of short-term capital gain property, in other words, appreciated property held for 12 months or less, is also valued at basis, and the deduction for a bargain sale of such property is limited to the gift portion of the property's basis. Consider the previous example, but now suppose that the gifted property was unrelated use tangible personal property. Because gifts of unrelated use tangible personal property can be deducted only at the lower of basis or fair market value, the donor in this case may deduct only the basis. However, the donor may not deduct the entire basis because part of the basis was applied to the sale part of the transaction and used in the donor's capital gain calculation. Instead, the donor may deduct only the gift portion of the basis, which in this transaction was $100,000. In other words, 20% of the original $500,000 basis. This has been Bargain Sale Gifts Part 2, Capital Gain Property. Join us next time for Bargain Sale Gifts Part 3, Special Tax Benefits.